Okay, so the Federal Reserve did it once again. They increased rates again. I think it's the 11th time in the last year and a half that they've done that. They've never done that in history, folks. So I want to go through and see how much my predictions, were we correct or were we completely off our rocker like ADP with their employment numbers? Let's get over to, we go to the Chicago Mercantile Exchange or the Board of Trade right here. And this was saying, this is what they're predicting based on how the futures market is rolling, what they expect the federal funds rate to do. Okay, so here's what these numbers are. So in previous meetings, they were raising rates. So we tried to figure out, what are they going to do this time? Well, this does it for us. So you can go to the the Chicago Mercantile Exchange, look this up. It's the federal funds futures telling us where they're going to go. Okay, where federal funds futures are right now are 4.75 to 5. Okay, that's where the federal funds rate is. It was expected to go to 5 to 5.25, meaning an increase in rates of 0.25%. There was a 91% chance they were going to do it in May, June, or July. And then after that, they looked to start pivoting and reducing rates. Okay, so let's see exactly what happened. Well, the Federal Reserve did what? They increased rates once again by 0.25%. So we were dead on the money. Okay, so that's good news there. The next thing is we want to go over to here is we want to look at the transcript that was just posted to see if there's any difference in the verbiage, because I knew it was coming up, but I didn't know what the future guidance was. This still isn't given to us, but when the Federal Reserve Chairman Powell speaks in front of reporters and Congress, he'll leave us some hints on what he's going to do there, and I'll come back to you guys within the next day or two, giving you more guidance on what the Federal Reserve is going to do in the upcoming meetings. But let's go through the transcripts real quick and see if there's any major changes that we should be aware of. So what this is the transcripts of what the Federal Reserve Chairman said they're comparing this statement and the last statement, or the last time he spoke on a Federal Reserve Day. So the scratch outs are what he said last time, and the news pieces are in here. So let's go through here. Economic activity expanded at a modest pace. Okay, that's good. Instead of a growing pace. So it's a modest from growing. In the first quarter, job gains have been robust in recent months, and the unemployment rate has remained low. Okay, that's in check. And if you saw my video this morning, I gave you my context on that and why I'm pretty sure I got a bead on why the employment numbers are doing what they're doing. So now let's get to it. The U.S. banking system is sound and resilient. Okay, is he pulling our leg there, or is it true? That's why if you watch my video from this morning, I was saying fake news when it comes to bank closures and our national debt ceiling. Please, guys, read through all that. And go to the next video if you're watching any of those videos telling you the banking crash and the debt ceiling is going to hit and the world's going to end. Please turn that channel. Okay, so then we get into U.S. banking system is sound and robust. Credit conditions. Here's where it gets a little bit crazy, and this is why I'm saying there's a recession right on the horizon. Credit conditions for households and businesses are likely to weigh on economic activities, hiring, and inflation. Okay. The extent of these remain uncertain. The committee remains highly attentive to inflation risks. Okay, so now they're going to tell us what they did. The committee seek to achieve maximum employment and inflation at a rate of 2% over the long run. In support of these goals, the committee decided to raise its target range of the federal funds rate from 4.75 to 5 to 5 and 5.25. The committee will closely monitor incoming information and assess the complications and for monetary policy. So now here's where it gets a little bit also kind of good, I guess. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, about time, the lag with which the monetary policy affects economic activities and inflation. I've been saying that for months now, and economic and financial development. Okay, so that, and then basically the rest of it is we want inflation in check and we want, all this other stuff. So we nailed it on the head when we said they're going to increase rates by a quarter. This information isn't really giving us really a bead on what their future intentions are going to be. So I'll continue to monitor his speech in front of Congress in Powell's speech in front of the media. And I'll get back with you probably within the next 24 to 48 hours with details on what I think they're going to do at the next meeting. So what's this doing to the markets right now? Well, the MBS market is still up 28. It was up like 33 before. So we'll probably get a reprieve in interest rates of about an eighth. That's 0.125. So if you're already locked in, you're still good because rates haven't gotten any lower. Between last Friday and this Monday, rates went up 0.25% within basically 2 trading days, and now we're back up 28, and we're coming back down. You can see all these numbers here. So that is my report for today, guys. So getting back to the Federal Reserve did increase rates by 0.25%, exactly what we predicted. And stay tuned on the further information what the Federal Reserve is going to tell us on their future rate hikes, or are they done? And hopefully they're done. Thanks for watching, folks, and I'll see you later. Bye-bye.